Okay, so we're back. I hope you have picked up good information at the starting point for those of you who have never traded before, those of you who need a little bit of information on how to get started, those of you with a little bit of concern about the kind of risk that you might be taking when you start trading in FX. I hope the previous section have answered all your questions or answered most of your questions. At this point now, we're going to get started with more slightly basic information guiding you through how to get counting, understanding how much money you're making, how much to risk, and all that kind of stuff. So let's get started. So counting in FX, counting in Forex. A lot of times you'll start hearing me mention pips. Pip, okay? A pip is a percentage in point. Basically, it is a unit of measurement for measuring the change in a currency pair. Take note that a pip is usually measured or is measured in a fourth decimal place. So with the examples that we have here, the New Zealand US dollar at 0.5854. That's the pip. 4 is the pip. Okay. US CAD at 1.4472. 2 is the pip. So if it goes to 1.4473, it's gone up by 1 pip. That's the fourth decimal place. When we have yen pairs, when there's a pair that has yen, JPY in it, we actually measure it to the second decimal place. So pound yen in this example, 131.93. 3 is the pip, and Aussie yen at 66.27. 7 is the pip. All right, so sometimes you will see that it goes to the fifth decimal place. We actually look at it only on the fourth. The fifth decimal place is considered a micro pip, or the third decimal place when it's a yen is called a micro pip. So take note that we only want to pay attention to the fourth decimal place or the second decimal place when there's a yen involved. So an example in how to count. It's a bit funny that we're teaching you how to count, but how to count in FX. When we have New Zealand, in this first example here, New Zealand US dollar, if the current price is 0.5800 and the new price goes to 0.5807, we would say that it's gone up by 7 pips. From 5800 to 5807, it's gone up by 7 pips. US against the yen, against the Japanese yen, at 111.17 to 111.37, it's gone up by 20 pips. 111.17 to 111.37 has gone up by 20 pips. The Euro US, the third example, Euro US at 107.673 to 108.675, it's gone up by 100.2 pips, right? So remember the micro pips has gone up by 100.2 pips. CAD yen at 77.00 to 784.456 has gone up by 145.6 pips. Okay, so I hope you gather how to count pips. We are looking at the fourth decimal place. The fifth decimal place is the micro pip. When we look at yen, it's the second decimal place that we look at as a pip. That's the upward move. Okay. On the flip side, on the downward move, I'll go through this a little bit faster because I think that you might have be quite straightforward to you. New Zealand US dollar from 0.5807 to 0.5800 it's gone down by 7 pips. US yen 111.37 to 111.17 down 20 pips. Euro US 108.675 to 107.673 down 102 pips. CAD yen 78456 to 77.000. It's gone down by 145.6 pips. Okay, so we've gone from ones to tens to hundreds of pips. That's how we count the movements of pips upwards and downwards. When you look at pips, when you look at currency pairs, when you look at trading in FX, it's a little bit different when we're trading in FX because of the sizes that we use. Remember, units. So Forex is traded in specific units called lots. So I'm referring units back to the earlier section when we spoke about leverage converting to units. These units are called lots. The number of lots is the amount of units you intend to buy or sell. So three main types of lot sizes. One is a micro lots. One micro lot equals 1,000 units. One mini lot equals 10,000 units. One standard lot equals 100,000 units. Okay, and remember, you don't have to trade in once. You can trade in multiples of these lot sizes. So 5 micro lots is 5,000 units. 2 mini lots is 20,000 units. Or 4 standard lots is 400,000 units. This as a whole, you can also see that, bringing back to the first example, 1 micro lot is 1,000 units, which also means that 10 micro lots equals 1 mini lot, because that's 10,000 units. So if you multiply 1 micro lot times 10, it's equals to 1 mini lot. 1 mini lot of 10,000 times 10 is 1 standard lot. So these are all just multiples of lot sizes. And when you trade, you actually make that decision whether to enter a micro lot, a mini lot, and a standard lot. At the end of this program, or at the end of today's program, I will be guiding you through what kind of trade sizes you should be entering based on your capital amount. I'll guide you to how to calculate your trade sizes as well. So when we looked at pips, counting in FX, how to look at pips, how to count, and your lot sizes in terms of a trading size. So pips is a measurement of price movement. Lots is the units of your trade sizing. It's important to realize that at different trading sizes, every pip move equals a different amount. 1 micro lot or 1 pip equals 10 cents. 1 mini lot for 1 pip equals $1. 1 standard lot for 1 pip equals $10. Straight away, you can see that it's more attractive. It's going to be more attractive to trade in a 1 standard lot sizing, because for the same pip move, for the same 1 pip move, you're earning $10 instead of if you trade it in 1 micro lot of 10 cents. You're earning $10 instead of 10 cents for that 1 pip move. However, it also means that if it goes against you, if it goes 1 pip against you, you could be losing $10 instead of 10 cents. Okay, so that's a very important point to note. A lot of times people are attracted. To the benefits of trading bigger. 1 standard lot, 1 pip equals $10. They're going to start trading 1 standard lot, although their account size might not be suitable to trade 1 standard lot. They're attracted to the benefits of that $10 move for per pip change, and they ignore the downside that if that pip goes against them, they could be losing $10 per pip. So it's very important, through my experience in teaching so many students over the many years, my experience is that a lot of times the biggest downfall that you can apply to your trading account is over trading, oversizing. This is one thing that I will talk a lot more slightly later, but with this in mind, you want to make sure that you're not trading more than you should. Trade the right size. Understand that it's about accumulation. Understand that trading is a long-term journey. build your accounts up from there rather than looking for that big jump overnight. So with profit and losses, you need to understand that pips and lots, by understanding pips and lots, you can work out your profits and losses relatively easily. If you're buying, for this example here, if you're buying 5 mini lots of Aussie US dollar at 0.6250 and you sell them at 0.6350, you would have made 100 pips. Okay, I'll repeat that again. If you're buying 5 mini lots of Aussie US at 0.6250 and selling them back to at 0.6350, you have made a profit of 100 pips. 100 pips for 5 mini lots at $1 per pip, it's $5 US per pip. $5 US per pip times 100 pips means you have made $500. Quite straightforward. I hope that is going to be quite straightforward to you on calculating how you're going to enter your mini lots or your standard lots or your micro lots. Main thing is that I want to impose upon you and remind you that it's all about accumulation, not over trading, not over leveraging, not thinking that you can do 5 standard lots in this scenario because your trading account, your trading capital might not sustain that if there were a downside move.